where paycheck is bigger than it was 3 years ago. But somehow, the grocery cart looks smaller, your rent feels heavier, buying a house feels even farther away, and when you check your savings account, it doesn't feel like you're getting ahead. So where did the money go? Because it didn't just disappear. Someone received it. Now here's the strange part. America has created more wealth over the last few decades than at almost any time in its history. Corporate profits have reached record levels in many industries. The stock market has repeatedly climbed to new highs. Technology has made businesses more productive than ever. On paper, this should have made the average American richer. Yet millions of middle-class families feel like they're running faster just to stay in the same place. How can both things be true? Imagine two neighbors. Both earn about $85,000 a year. Both work full-time. Both save a little every month. One slowly builds wealth. The other falls further behind every single year. Neither is reckless. Neither is lazy. Neither made a terrible financial mistake. The difference isn't just what they earn, it's the invisible system they're living inside. Most people think wealth moves in obvious ways. You work, you get paid, you spend money, you save what's left. Simple. Except that's not how the modern economy actually works. Money is constantly moving before it ever reaches your bank account. Sometimes through prices, sometimes through assets, sometimes through policies that barely make the evening news. By the time most people notice, the transfer has already happened. Take housing. A young couple spends years saving for a down payment. Every month they get a little closer. Then home prices rise another 8%. Mortgage rates move higher. Insurance costs increase. Property taxes follow. Suddenly, the finish line moves farther away than when they started saving. They didn't lose money, but somehow they lost purchasing power. Someone else gained from those rising values. That's the first clue. Or think about a nurse. She receives a 4% raise. Sounds like progress. But her rent climbs 6%. Health insurance costs more. Childcare costs more. Her car insurance jumps again. By December, she's working just as hard for a lifestyle that quietly shrank. No dramatic crash. No financial emergency. Just tiny changes that compound month after month. Almost too small to notice. Until one day, they're impossible to ignore. This isn't simply inflation. It isn't just corporate greed. It isn't just government spending. And it isn't just the Federal Reserve. Those are pieces of the puzzle, but none of them explain the full picture. Because beneath all of them is a system that quietly determines where new wealth flows first, and who receives what's left over. Most Americans experience the results. Very few ever see the machinery. Once you notice that machinery, headlines start looking different. A booming stock market doesn't always mean families are getting richer. A growing economy doesn't automatically mean the middle class is winning. Even falling inflation doesn't guarantee life becomes affordable again. That's the contradiction. And it's not an accident. So here's the question. If America keeps creating more wealth than ever before, why do so many middle-class households feel like they're slowly losing ground? To answer that, we have to follow the money. Not where it ends up, but where it goes first. Let's start with something almost everyone experiences. Payday. Your employer deposits money into your account. It feels like that's where your financial story begins. But in reality, it's one of the last steps. Long before your paycheck arrives, money has already been flowing through a chain of decisions that determines who benefits first. To see it, we have to follow a single dollar. Imagine a manufacturing company. Business is growing. Sales are strong. The company makes an extra $1 million this year. That money could be used in several ways. Raise employee wages, build a new factory, lower prices for customers, or buy back its own stock. Over the past 2 decades, many large American companies have increasingly chosen stock buybacks. A stock buyback means a company purchases its earned shares from investors. With fewer shares available, each remaining share often becomes more valuable. If you own those shares, your wealth can grow without producing a single extra product. Meanwhile, employees may receive only modest raises that struggle to keep up with rising living costs. The same company created value, but that value didn't flow equally. Now, zoom out. Who owns most financial assets? According to Federal Reserve data, wealth in the United States is highly concentrated, with the wealthiest households owning a large majority of stocks and other financial assets. That means when asset prices rise, the biggest gains often go to people who already own significant assets. If your primary asset is your paycheck, you're playing a different game. Housing works the same way. Picture 2 families. Family A bought a home in 2018. Family B started looking in 2025. Family A watches their home's value climb. They can borrow against that equity. They may refinance, invest, or simply enjoy a growing net worth. Family B faces higher prices, higher mortgage rates, larger down payments, and higher monthly payments. Both families work hard. Only one benefits from owning an appreciating asset. The other is trying to catch a moving target. This is where many people confuse income with wealth. Income is what you earn. Wealth is what you own. A software engineer earning $150,000 but renting may actually build wealth more slowly than someone earning less but owning appreciating assets. That's because assets can grow while you sleep. A paycheck stops the moment work stops. Then there's inflation. Most people think inflation simply means prices go up. That's true, but the timing matters even more. Imagine fresh money entering the economy. It doesn't appear in every American's wallet overnight. It enters through banks, financial markets, government spending, business loans, and large institutions. The people and organizations closest to that new money often spend or invest it before prices fully adjust. By the time the effects spread through the economy, everyone else faces higher prices. Economists sometimes call this the Cantillon effect. The idea is surprisingly simple. The first people to receive newly created money can often buy assets and goods before prices rise. Later recipients pay those higher prices. The order matters. Now think about your savings account. For years, many Americans earned almost nothing in interest while inflation quietly reduced the purchasing power of their cash. Imagine leaving $10,000 untouched. The number in your account barely changes, but each year that same money buys a little less. The dollars stayed. Their buying power didn't. It's like watching ice slowly melt. You don't notice it minute by minute. Consumer debt creates another layer. Suppose someone uses a credit card to cover groceries after an unexpected medical bill. The balance grows. Interest begins to compound. Soon they're paying interest on previous interest. That monthly payment becomes permanent. Money that could have gone towards savings or investing now flows somewhere else instead. Not because of one bad decision, because one difficult month became years of repayments. Student loans tell a similar story. A college graduate lands a decent job. The salary looks respectable, but every month hundreds of dollars disappear before they can build savings or invest. Another graduate with identical income but no student debt reaches financial milestones years earlier. Same paycheck, different destination. Meanwhile, headlines celebrate rising markets. The S&P 500 reaches another record. Corporate earnings beat expectations. GDP grows. Those are real achievements, but they don't automatically translate into stronger household finances. A family doesn't buy groceries with the Dow Jones. A renter doesn't negotiate lower rent because the Nasdaq had a great quarter. Financial markets and everyday life often move on different timelines, sometimes different tracks altogether. This is why so many Americans feel confused. They're told the economy is strong. Their own experience feels different. Both can be true, because the economy isn't one single machine. It's a network of systems. Some reward labor, others reward ownership. And over time, ownership has become increasingly powerful. Which raises an even bigger question. If wealth keeps flowing toward assets, what happens to a society where fewer people can afford to own them? Here's what's fascinating. None of the systems we've talked about were originally designed to make the middle class poorer. Stock markets exist to help businesses raise capital. Mortgages help families buy homes. The Federal Reserve tries to keep prices stable and employment strong. Companies try to maximize profits. Investors look for returns. Each piece has a logical purpose, but when all of those pieces interact over decades, something unexpected begins to happen. Think of the economy like a river. Every year, America creates trillions of dollars in new income, profits, investment, and productivity. The question isn't whether the river is flowing, it's where the water ends up. If more of that flow reaches people who already own homes, businesses, stocks, and commercial real estate, their wealth compounds. Not because they're working every hour of every day, but because their assets keep working even when they aren't. Meanwhile, families who depend mostly on wages are trying to fill a bucket while the river keeps changing course. Technology is accelerating this divide. Artificial intelligence can help one engineer do the work of 3. Automation allows warehouses to ship more packages with fewer workers. Software lets a small team serve millions of customers. That's incredible for productivity. Historically, higher productivity has helped raise living standards. But productivity doesn't automatically decide who receives the rewards. Ownership does. If AI allows a company to double its profits, the benefits can flow to shareholders, executives, lower prices, employees, or some combination of all four. Technology creates value. The system determines where that value goes. Now add housing. For decades, owning a home has been one of the primary ways American families built wealth. As home prices climbed faster than incomes in many areas, existing homeowners saw their net worth grow. First-time buyers faced a different reality: larger down payments, higher monthly payments, more years spent renting. The result is subtle. One generation builds equity, another spends more of its income simply gaining access to the same market. The wealth gap widens, not overnight, but one mortgage payment at a time.